How do you buy a house with no money?
You go and you find a property that you like, and certain renting a home, might not be advantageous, but there are times where renting is cheaper than owning. The sixth commandment of wealth. This one's kind of a basic one, and a lot of people don't follow this, but it is kind of important. It's thou shalt make of thy home a profitable investment. And a lot of people don't even know what that means.
Hello and welcome to this episode of the Edgar and Allen Not Poe show. I'm your host, Edgar the Connector, and the co-host is Allen, Mr. Financial Foster.
Mr. Financial. I like that. I am Mr. Financial. Thanks, Edgar. I'm going to take that name. How are you doing today?
I'm doing good, man. I'm going to take your line. I'm like $100 bill. Green and wrinkly.
Yeah.
Did I say that right?
You said it's all green and wrinkly. That's the way to say it.
A little bit of grays.
You look good today. You look good. I know what it is. You're not wearing your hat.
There we go. So today's episode on the Poe, we're still Poe, but we're less doom with more bloom. Going with the poetic nature of Edgar Allan Poe.
You are good, man.
Well,
You're the best partner I've ever had.
Second, hey, Miss Andrea, we can't count her out. She's number one.
Oh, yeah. That's right. She is my number one partner. I'll bring her on one of these episodes one time so you can see the real power behind me. Because
Awesome.
Without her, I'm nothing.
Excellent. Same thing with my wife, the missus.
All right. Your wife is awesome. You're lucky, dude.
Thank you.
Count your lucky stars, man.
Thank you. We're both lucky men.
Yeah, absolutely.
What is your number 6th commandment of wealth?
The sixth commandment of wealth. This one's kind of a basic one, and a lot of people don't follow this, but it is kind of important. It's thou shalt make of thy home a profitable investment. And a lot of people don't even know what that means. And we had talked earlier about money going into pay yourself first and then money going towards your mandatory expenses. Well, housing's a mandatory expense. At any time that you can take those expenses and make them profitable, like on your house, maybe if you're renting, that's different. But if you own your home, which I advocate for owning your home, if the costs of owning the home is actually cheaper than renting the home. And if you're an investor in real estate, this won't take much long to figure out as far as the cost, to acquire the property, the cost to close on the property, the cost to maintain the property, to pay the property manager, pay the property taxes, pay the insurance on it. All those costs are included if you own the home and want to live in it. So the price you paid, the mortgage you pay, and the actual amount of money that you spend to maintain that property. Now, you don't necessarily have to do a property manager because you may manage your own properties and you wouldn't have to factor that into your numbers. But what you want to do is you want to compare the two to see which way is really cheaper for you. If you can make owning the home profitable, renting the home, might not be advantageous. But there are times where renting is cheaper than owning, and that is the best way to go. But anytime you put money from step number 3, which is your mandatory expenses, anytime you put money in that bucket, if you can find ways to make money with those expenses, do it. Do it. If you can, buy a car, you need a car, and maybe it's got autonomous driving, and this new technology is out through Uber. You can lease your car out to Uber while you're sleeping, and they can drive it autonomously around town if you got a Tesla, because it's got the technology built in. Pick up passengers while you sleep, drop it off, take it to the car wash, wash it, and then it'll wind up back in your driveway in the morning when you wake up. So you've turned a liability, a car, into an asset. So, and you use the car to get to work. But you could also do this with your home too. There's other things that you could do with your home to make it profitable. You could rent out spare, maybe you got a basement, maybe you got an ADU in the backyard, you can rent that out. Other things you can do to reduce costs, like maybe you could put on a solar panel, to save on your electric. You could build a garden, grow your own food, save you on your food costs. So any money that you could put into your home that will lower your costs that you put into your expense buckets, that's considered a cost savings. And I want to be clear about how income is determined. It's a very simple accounting equation. Revenue minus expenses equals income. Don't mistake revenue for income. If you have a business and you want to increase your income, you can do that one of two ways. You can either increase revenue or lower your expenses to increase your income. And those are the only two ways. You can do a combination of the two, but basically those are the only two levers you have to pull. Same with your home. Anything you can do in your home that will reduce a cost that you would normally put into your expense bucket and you could put into your home bucket and save money there, do that. Anything on your home. Make your home profitable. Maybe you can do things, maybe you have a large piece of property and you can, I can't imagine. There's all sorts of things you could do. You might even have mining rights on your property. I don't know if you're out in the Midwest or in a mountainous area. You could sell your mineral royalties for your mineral rights. There's all kinds of things you can do. You just have to find out what's available to you. But, there's inexpensive ways to buy homes with no money. And a lot of people don't even realize this. Most people think they got to do creative finance. You do not have to do creative finance to buy a home with no money. You want to know how you do it?
Like most entrepreneurs, I don't sleep enough. So the hours that I do sleep need to be of better quality. The 8 Sleep Pod, it has been a game changer for me. Perfect temperature all night, less snoring, and I actually wake up refreshed. And my wife does as well, which is a huge plus. Happy wife, happy life. You can try it through my affiliate link below. Now we go back to the episode. Yeah, definitely, of course. Let's do it. How do you buy a house with no money?
You go and you find a property that you like in certain rural areas. You go to the USDA and you get a USDA loan, which is the U.S. Department of Agriculture. They will finance the entire home. The only thing they require you pay for is the inspection. That is it. That can cost you about $400. And if you're a handyman, you can do your own inspection, which I don't recommend, but if you want to, you could theoretically go do your own inspection and do it for no money. But it would only cost you $400. Well, it depends on what the cost for inspectors. Like you're in New Jersey, which I don't think these are available in New Jersey, but those inspectors can be $800 to $1,000. But if you're out, say, Kansas, inspector might charge you $250, $350. You can buy that home, no money, and they're going to give you normal rates. These loans are not going to be like high risk loans because you financed all of it. You're going to get a normal rate like you would under an FHA loan. They follow FHA guidelines and VA guidelines even. It's like a VA loan for people who buy in rural areas. So if you like the idea of living in a rural area, because today most people don't need to live in urban centers, and most of us make money online. We don't need to live in New York City. We can live in Ohio on a piece of property that costs us next to nothing, financed for no money, and put a solar array on it to have our own power. Put in a well and septic system. You could have your own water. There's a number of things you could do to make your home a profitable investment. And, of course, it goes up in value over the years, assuming you maintain it, of course. Right. Homes need attention just like every other asset.
All right, before we go too far, remember, we are entertainment purposes only. We're not financial advisors. This is not financial advice. But going into the USDA loan, do you know what the restrictions are? Is there acreage limit, minimum?
There are income limits.
Oh, income limits, okay.
Yeah, so the actual income limit, and I might be off about 10 grand on this, but I believe it's 120 grand. That number goes up if you have more kids. If you have like a lot of kids, they'll add it's like $10,000, something like that. I got to go look at the actual specific details of it. But you could go get these loans, and you can qualify for them as long as your income does not exceed a certain dollar amount. It's higher for married couples, but it follows similar to what you would find under your typical tax brackets for like a single filer or a married filer or something like that. You could do these loans. I mean, but there's other things too. Maybe the property that you like is not in a USDA approved area. FHA loans only require 3% down. So if you're looking at a $250,000 home, you're only going to need, what's that, with 7,500 bucks down. And, most people nowadays struggle to find that, but it's not hard to do if you focus. If you follow the first step, paying yourself first, and in your second one, know thy expenses, and you set aside in your expenses a house cost that's coming in the future, you can do this. You just have to give your money a purpose. And as long as you do that, doing these types of deals to buy your own home and make it a profitable venture, very doable, very doable. I mean, I know somebody who actually has a home in West Virginia, and they have their own garden. They grow most of their own food. He's got a solar array on it, so they generate their own power, and of course a well and septic. The only thing that I think they have to pay for is trash pickup. There's no HOA fees.
And even then, if you manage your trash right, you can basically compost a lot of it.
You could. I know some jurisdictions. Yeah. Some jurisdictions are like, no, not do. So you got to be careful about that kind of stuff.
Right. And then getting the USDA loan too, if you buy the property right, I'm not sure what the minimum is. Again, you have to verify this. You're able to get like agricultural taxes. So then your taxes are a lot less.
Yeah.
If you can do that as well. Yeah. So you get your loan at 100% and reduce your tax rate.
Man, Edgar, you are right on the money with that one. Ag loans, they get very favorable tax treatment. You own a piece of property, you got a USD loan, and it's big enough, maybe you could qualify for a farm and just grow enough to meet the federal government's requirement to qualify as a farm. You could get agricultural discounts. And I do believe you touched on something there that I didn't think about. Yeah. If you did something like that, you could get an R&D deduction right off of your personal income tax. If you're investing in something and you're researching and developing it, you could take that as a deduction. It's perfectly legal deduction right off your income. There's a gentleman that I was listening to him. He makes jelly at home, and he writes off the R&D to develop the jelly that he makes that he sells. And that R&D cost is a direct deduction from your income. Of course, you got to structure yourself as an S Corp, and we can talk about stuff like that later. You can't just have that under a C Corp, because then the C Corp owns the jelly and you can't take it. It's one of those things. But there are things you can do to further reduce your expenses from your residence that you do at your home.
Definitely. I didn't think about R&D, but that's what a lot of the big corporations do, right? Like Apple, all their research and development that they're putting into
nothing wrong with you and I doing that too. We can do that. Right. Anyone can take research and development right off of their income tax. If maybe you're putting together a cookbook, your grandmother's cookbook, right? And you got to research some of the recipes. All that cost that you put into this is deductible. It's research and development, man.
Wow, you don't know what you don't know. So you just open your mind. There was so many different things. And then going back to FHA loan, also there's one FHA loan where you can actually get like a rehab loan into it for a certain amount. One of my previous guests on the other podcast, Dream Start Own, mentioned that they got a loan that way, and for their first house, the triplex they did.
Oh, it's a great way. It's a fantastic way. Some of these FHA loans will go up to 120% of their value. So give you some quick math. Let's say you're looking at a property that needs about, make up a number, say $20,000 worth of work, and you can buy it for $100,000. FHA will let you borrow up to $120,000, so you can roll those construction costs right into the loan, and then but the problem with the FHA, you have to live in it for 1 year. So if you're a flipper, you can't use this strategy. Now, if you're using the BRRRR strategy, which is where you buy it, rehab it, rent it, or live in it for 1 year, and then you can rent it out after 1 year or sell it after 1 year, then it qualifies. And under those rules, it would still fall under, since it's your primary residence, you would still get the $250,000 tax exemption on capital gains on it. So that is something some people do as a strategy. Now, if it's part of your business and that's what you do all the time, that 250K is not going to fly with the Imperial Revenue System. That's not going to work. So it has to be your personal residence, and under FHA rules, you have to live in it for 1 year. But you can have as many of those loans as you want. That's the interesting thing. Because once you do one FHA loan, you go a year, you rent it out, buy another one under FHA loan, rent it out, do another one. I think you can do up to 10 of these.
10. Yeah, you can do up to 10. And make sure your debt to income ratio stays below 50. But again, you have to double check all this, but this is just off the bat what we'll remember. And then FHA loans, you do have to live in it for a certain amount, depending on your loan origination. Got to look at those documents. So it's not good for if you're already an experienced investor, unless you're going to move into it. So this is great information for people that are buying their first property or ready to buy a second property, about to move in, on what they can do. So that's very good tips there. And then now for investors that don't want to live in rural, don't want to do an FHA loan. One thing, back when I was younger, I had always heard, start a business, but I never understood why you should start a business, what the actual benefits are. So with starting a business and you working from home, that area that is your home office, that's a tax write-off. You include your closet as well, and then any specific things you do for that office is also a tax write-off going off of your income. Again, entertainment purposes, you got to verify with your CPA.
Yep.
But this is ways to save taxes. And then again,
go ahead, Edgar, go ahead.
Going back to the USDA, no worries. Going back to the USDA loan and the FHA, if you are buying these properties at 100% value, loan to value ratio, you need to make sure it's something you're going to keep for at least 5 years to be able to make it worthwhile. Because you try to sell it before that, you're not going to, very small chance that you're going to make your money back or a profit off of it.
Yeah, that's a true statement. I had a thought in my head and then I lost it.
I was talking about the home office, writing it off.
Home office, quick rule on home office. And if you have a home office and you're doing that and you're trying to get a deduction using your home office, and just remember that for it to qualify for home office, it cannot have any other use other than your business, which means if you have kids, they can't come in and use your office to do their homework. You cannot entertain in there. That is got to be specifically for business use. So be very careful if you're going to do the home office deduction and you got a little corner of your room set up and I'm going to do my business right here and I'm going to deduct this many square feet off of my taxes. And then you also pay your bills there. Your husband or wife, you constantly use the computer you have upstairs. They're using it for personal. That becomes a problem, and the IRS is not going to be your friend on that. The Imperial Revenue System is not your friend. They're your partner, but they're not your friend.
Right. I think you double check it though, because I think you can do instead of a full write-off in your home office, you can do like a percentage. So you use 60% of it for your home office.
Yeah. There are rules, but in general, try not to use it for anything else except your business. If you do that, you're golden. But there are certain things they will allow. I think cell phones are one of those rules. You can use a certain percentage of it for personal calls.
Yes. Yep. Internet, your utilities basically will be a percentage, the size of your office, and then the percentage that you use it, from what I recently saw. But again, this changes. This might be a year later. The rules have changed. So as of 2025, that's the way I understand it.
I should chat GPT that right now and see if there's any case law on that.
What other home tax savings do you think there are for people that have their own LLC?
Well, if you're borrowing the property, a couple of tax deductions, borrowing to buy the property, say maybe you put 10% down, 20% down, 5%, whatever. The amount that you borrow carries an interest, which most people know they can deduct that. But what they don't know is they can also deduct their private mortgage interest or insurance. Well, what is that? So the private mortgage insurance is if you buy a piece of property and you do not put down at least 20%, banks charge something called a private mortgage insurance. So should you default, you're basically paying for an insurance policy that will cover the bank in case you default. So the reason they do that is that if you've got 20% of your money in the game, they feel that you're going to do what you got to do to make that mortgage happen. Anything less than that, you're a bit of a high risk. So they want some extra insurance to cover that. But that mortgage insurance premium is a tax deductible item. And a lot of people miss that on their taxes. You can deduct all the interest and you can deduct your mortgage insurance premium. And if you bought the home in that tax year, you can deduct a lot of the fees from the closing, such as loan origination fees, discount points, things of that nature. Any property taxes collected at closing, although that usually nets out in the tax bill, but those are deductible items on your taxes, property taxes. Now, the rule with the new SALT rules for taxing, like which is you could go with property tax, or you can deduct your, what do they call it, your sales tax, and then they have limitations on how much you can deduct. Like if you live in a high expensive, like say you live in New York or New Jersey, homes there are like $1 million, and there's only so much that you can deduct in the way of property tax, and there's only so many deductions you can take on your home up to a certain threshold. And the more expensive your home is, the more you have to cover out of pocket, and you cannot deduct from your taxes. So you got to be very careful about how much you buy for a home to live in. Because if you're buying $1 million home, it's nice, it's great, you get status, people think you're cool, but a lot of your tax deductions go away.
Excellent advice. For Texas, I don't know what other states have this. We actually have a homestead exemption as well. That's something to remember. When I bought my first house, the first 2 years, I didn't know about it till somebody came in knocking on my door trying to charge me to sign up for it. And then, so that's especially just go to your county and see how do you apply for homestead to reduce your taxes. Your mother-in-law calling again?
That was my phone. My phone always takes over the Bluetooth, so.
Yeah, check online your county tax to apply for your homestead exemption. That'll be a big tax savings. In Texas, it's huge. Also, if you do a refinance, let's say you bought the house before, and then when you do a refinance, you're married, double check. That could actually remove your homestead and you have to redo it. I learned that the hard way as well. So just tips here for that. If you are your primary, anytime you refinance it, add a name to it, or when you buy your first house, check into homestead exemptions to save on taxes as well.
Yeah, that's great advice. Real
Excellent.
good advice.
And then, so talk to conventional loans. Oh, VAs, if you're a veteran and you qualify for it, you can also get a VA loan at 100%. So that's something good to look at as well for the veterans out there.
VA loans, you don't need a down payment. On the VA loans, you can actually have the seller pay your funding fee, which is, I think, 2% of what you're borrowing. There's a funding fee. Most banks charge what's called a mortgage insurance premium. The VA charges a funding fee. It's just a one-time fee, you're done. And since the federal government guarantees that loan, there's no mortgage insurance on this. It's just you have a payment and that's it. You pay your one-time funding fee. The seller can offer closing costs help to help fund that for you. And if they do that, a lot of times what they'll do is they'll just raise the price a little bit and cover that cost. Just have to keep in mind that the appraiser still has to verify I've lost my train of thought. Make sure that the property will appraise for what the new valuation is by rolling that funding fee into the price.
Excellent. I didn't know about that one. Some other ways to make income with your property, your personal property, is if you buy like a multiplex, a duplex, triplex, or fourplex. Of course, to rent out those other units. Or if you're not using too many bedrooms, you can rent out your other bedrooms through like Airbnb platforms and be able to make money that way. So other ways we can make money on your personal property, there's a website called like Neighbor. I believe you can actually rent out different areas of your place. If you have driveway space, if you have garage space, you can rent out sections there to make more stuff.
What's that website called? Neighbor?
Neighbor, I believe it's Neighbor.
That's actually, that's good stuff. There are other ways to make money to make the Commandment number 6 work.
Yeah, definitely. I'm going to look into that because I have a pretty long driveway, so I can actually rent out a section to put a car there.
Okay.
and then be able to still pull out my car from the garage without it being in the way.
Like someone who needs to store a car there and they don't have a driveway or they don't
Yeah,
drive. Oh yeah, you could do that.
there's
Or
some.
maybe or near a ballpark and they just want you could charge the park in your
Yeah,
driveway for the
yeah,
game because you're walking distance. I don't know.
definitely. That's something else you can do. There is actually a website for that. I don't remember what it's called. If you have a pool, there's a place called Swimify. You can actually just rent out your pool.
Yeah, you could do
There's
that. Of course, I'd be scared of the liability, but yeah, that, if my kid drowned in your pool, man,
Yeah, I think you'd have to.
may- you definitely want some
I'm
insurance
pretty
for
sure
that.
check your documentation on there, but they should have some insurance. You would assume, but I don't know for sure. Do you research? Your due diligence is the biggest thing. Due diligence,
Oh,
for
yeah.
those of you who don't know, is doing your research or verifying that the deal, whatever you're doing, whatever you're signing, investing in, is what they say it is, and it should make sense.
Yeah. It's always your responsibility. And there's a saying in real estate, buyer beware. That can't be any more true than what Edgar's talking about. Another thing, have you heard of the Augusta Rule?
Dude, you read my mind. I was about to say the same thing.
The Augusta Rule. So I think it's the Masters tournament. It's in Augusta, and that's where the name comes from. The code, I can't remember the actual code in the Imperial Revenue Code, but it gets its name for the Masters. People that lived in the area, there was so much demand to go to the Masters tournament. People were like renting their houses out to folks, just for the Masters, and they were getting these ridiculous amounts of money. Well, in the tax code, that's technically income. However, under the Augusta Rule, you can rent out your property up to 14 days a year, and you do not have to pay tax on that income. So you could rent out your personal property for things like that, like an Airbnb style deal. I mean, of course, you got HOA rules and other stuff too. But yeah, you could do something like that and not have to pay tax on it. Up to 14. You go to 15 days, then the Imperial Revenue System, they want their cut. Your partner wants to get you, they want to shake you down for the rest of the, yeah, so there's that. There's one other thing on that Augusta Rule that I'm leaving out that most people don't know.
Yeah, so I actually have a pamphlet, a whole setup on it. So if you guys are interested in that, leave a comment below Augusta Rule with your email, and I will send you what I have.
Yeah.
A lot of business owners will rent out their property to their LLC, so they get that income tax free, and then it's a write off on their property. But you do have to document it, which is shown in the paperwork that I share with you, to show that it's a justifiable expense, and you have to be able to rent your property at a market rate. You can't charge $1 million for it.
Right. Yeah. You're absolutely right, Edgar. I mean, that's exactly how the IRS looks at it. And some things you might want to do is you might actually want to have a signed lease with your LLC for certain dates, number of days a year at a certain set rate. And you'll have verifiable comps in the area, the other venues to do like a board meeting at your residence. That would typically what you would pay, and you could charge similar or less. I recommend less. The other thing is you have to make sure that you actually pay with a check or some form of payment system. You can't just take this as like an IOU, or something like that. You have a fee to rent the property, to hold a board meeting, or have a business meeting, or whatever, a partners meeting. Whatever it is, you can charge the fee, you take in the income, and you get it tax-free. Your company who pays it gets the tax deduction, which if you're a C Corp, you're probably saving yourself 21 cents on the dollar. And depending on how you're structured, depends on where your bracket falls. But in those particular scenarios, you want to make sure you have a paper trail, because if you ever get audited, they're going to want to see that. They're going to see the lease, and they want to see the paper trail that you actually got paid on that date. You can't just like fabricate checks that happen months later. There's you got to have it around the time that you actually use the property for, and definitely document the meeting. You can use Otter to do like a recording of the meeting, and we'll summarize the meeting for you, and have everyone sign it and put it in your company, your books where you keep all your legal documents for your corporation. There's lots of things you can do. But yeah, like what Edgar, you were saying is make sure you do it the right way. Don't just make stuff up. Don't make up sheep dip.
Yeah, it's a powerful tool. Make sure you use it correctly. Be responsible with it.
Yeah.
Excellent. Yeah, there's so many different ways to make money with your personal property, your your primary house. So when you go to buy it, try to find those ways.
That's
Definitely.
right.
Great information for this episode. On the next episode, we'll talk about Commandment number 7. You'll see it there. Thank you so much. Please give us a thumbs up. Subscribe to the channel. It's free. Doesn't cost you a thing. Drop a comment. Let us know if you want more of these. Right now, we're going to be at 7. We might do more if you really enjoy these. So for this episode of the Edgar and Allen Not Poe show, till the next one. See you later, guys.
Bye. Thank you, everybody.
Catch this next podcast where you can start your dreams and start to own your time the way these other guests have.